Okay, we are back. I'm very happy to have on the Goldstein on Gelt Show Professor Lars Peter Hansen, Professor of Economics at the University of Chicago. He's the Research Director for the Becker-Friedman Institute. Those of you who were listening to the Goldstein on Gelt Show a few weeks ago heard the interview we had with Nobel Prize winner Gary Becker. And now Lars Peter Hansen has just won the 2013 Nobel Prize in Economics. Congratulations.
Thank you very much.
So the work that you do seems to be about connecting or finding the connection between macroeconomic studies and, let's say, financial markets. In fact, people say that amongst the 3 Nobel Prize winners that won this year, you're sort of the practical guy. Is that a fair description?
Practical is an interesting word here. I think of myself as the person who's very much into models that build connections between the macroeconomy and financial markets, testing those models, figuring out what's wrong with them, and figuring out ways to fix them. I have a very strong interest in statistics and the use of statistical methods to analyze such models. So if you want to call that practical, you could, I suppose.
Okay, so let me ask you a practical question. I'm sure that a lot of people have asked you, and depending, time permitting, I'm going to ask you too to discuss some of the work you've done for the prize. But my day job is that I am a financial advisor. I get to do the radio gig once a week and talk to interesting guys. But in real life, I sit with people and I talk to them about their income and their expenses and their stocks and their bonds. And the tool that I use the most when doing financial planning is a Monte Carlo simulation, which originally was sort of a high-level economics thing in order used to test hundreds or thousands or millions of possibilities. But now it's become a little more popular in the world of financial planning and decision-making. Is that a reasonable tool, you think, in the world of practical decision-making?
Tools and kind of refinements and modifications of tools like that are very useful because it's critical to try to account for uncertainty. Now, we're not always perfect at it. We might get fooled about the nature of the uncertainty, but to at least try to account for it is absolutely critical. And tools like that are very useful in accomplishing precisely that.
And do you think, have you ever seen one of these practically used in terms of financial planning?
So I use tools like this in my own research in order to try to assess models and even the models that interest me are models that have investors inside the models, right? So we have to model people like you inside our models to figure out how financial markets work and how they interact with the macroeconomy. Now we have to take lots of simplifications and the like, but at the same time people inside our models have to engage in decisions about investment and the like, and we have to have stylized versions of that, and we certainly have and some of the more interesting ones are which the investors inside our models are kind of using methods like you're describing in order to figure out their own decision making.
So one of the things that I've found with using these sort of models, and when we present a plan to a client, it's packed with disclaimers and past performance is no guarantee, and this is just a model. And sometimes people read them and they say, Doug, if this is the case, why are you writing this down? And I tell them, well, the math is good, at least as much as I can tell, but at the end of the day, a person has to make a decision. Is that something that you find kind of gets in the way of your study as an economist?
Gets in the way is a little bit too strong. Maybe it certainly adds a challenge. So the way I like to think about this is models are guides for decision making, and you need to use them with a little bit of caution and a little bit of skepticism. One can imagine the model captures everything, all the uncertainties, captures probabilities of all the events correctly, but that's pretty far-fetched. So even inside our models, we have to imagine investors who face a little bit of a struggle in terms of how to assess all the relevant uncertainties going forward.
Okay, we are talking with Professor Lars Peter Hansen from the University of Chicago. He just won the Nobel Prize in Economics for the year 2013. The business that he's in, the side of the economics that he studies, has a lot to do with taking statistical tools and economic tools that are often used in universities and finding ways of applying them to real life. So, a lot of times, Professor, people on both the left or the right seem to have some kind of very, very strong opinion. You have the free market economists on one side and the government control economists on the other. Is the work that you've done something that may be able to be used to actually finally bring an end to the fight because you could prove which one is right?
Yeah, very, very important question. So part of what really motivates me is trying to figure out the evidence that helps us to sort through alternative competing models. And places in which the evidence is very weak opens a possibility for lots of disagreements, and places in which our kind of evidence and knowledge base and modeling is strong then narrows the gap. So as a field progresses, as a field makes advances, gets better models, gets better evidence, then the scope for disagreement will hopefully diminish. I'm personally involved in a project that with my good friend Andy Lowe, who's at MIT, and a few years ago we brought together a whole group of distinguished economists that have strong ties in finance, some with strong ties in macroeconomics, to explore conversations about how we can build the next generation of models with macro financial linkages that will help us think better about how to engage in financial market oversight. How can we think better in more systematic ways? What are useful ways to engage in financial market regulation versus when should we let markets go and kind of do their own thing? And I view this as absolutely critical going forward. The financial crisis exposed, of course, it had lots of social consequences that were adverse, but it also exposed gaps in our knowledge of both the macroeconomy and how it linked to financial markets. And there's great challenges going forward to try to close those gaps and close them in ways that are useful for improving policy going forward.
So it seems to me there's a huge amount of data out there. You mentioned the problem of that the evidence is weak in certain areas. But in other areas, it seems to me there's been a huge amount of data and experimentation both in the United States and all around the world. For example, flat tax versus a variable tax, higher taxes versus lower taxes. And yet the two sides the many sides seem so separate. They're so far away from each other. Is it simply that we don't have enough information to know whether higher taxes is good for the world or lower taxes are good for the world, for example?
Yeah. Well, it's hard to imagine that higher taxes in the abstract are good for the world unless we talk about what the taxes are going to be used for. So we have to talk about costs and benefits at the same time there. But if you do look at questions like fiscal stimulus, for which there seems to be a lot of divergence of opinions, there's even though there's lots of evidence along some dimensions, a lot of that evidence doesn't get directly at the relevant policy questions, which are critical. So it really depends what type of evidence. Sure, along some dimensions we have very rich evidence, lots of financial market data and the like. But the data that really helps us understand linkages between kind of the overall macroeconomic performance in financial markets is really much less precise. Yet those type of things are critical. Or even the amount of evidence we have about taxes and incentives is, we have some evidence, but there's still much scope for disagreement.
Okay, so the area that's coming to mind would be the U.S. debt, which is since we've started the talk has increased by a few $1 billion. But on one side there are economists who say you can just do more of that, and again it seems that there should. I'm speaking as not as a layman, but as someone who's not an economist. But it seems that there should be enough evidence to test whether an economy can sustain a certain amount of debt or not, and then we can make a policy decision based on that.
Yeah, so a lot of these are kind of long-term consequences. So when they talk about debt, part of it is the case is what are we imagining is going to happen in the next 3, 5, and 10 years, and what policies might we imagine will be feasible to put in place down the road that will help us address this problem. And so there's always this temptation to rule things over to say, well, here's this problem, but we have a long time. We can kind of solve it over many periods. So maybe we should just solve it later as opposed to today. And that's and so at the same time we're trying to analyze how important this is as a problem. We're also making guesses as to what the policy responses are going to be going forward. And so it's a lot of the decision about acting today versus acting in the future. My own perspective is that I would like us to be acting today and not continually to roll over problems into the future. But there's certainly debates about that.
Yeah, question whether people are ready for that austerity. So you gave the example of, I guess the term they use a lot is just kicking the can further and further down the street. As an economist, do you feel that the work that is out there on the academic level is actually dripping down into politics, or at the end of the day, it's just each politician is only focusing on his next re-election?
Yeah, I think it's but again, this is a case where we had some really sharp evidence about consequences, then arguably it might have a stronger focus. But I think a real issue here is the fact that these are long-term problems, and often our politicians are almost forced into taking short-term positions or short-term vantage points because of their election cycles or the like. And I think that really can get in the way of making these hard long-term trade-offs.
All right. Okay, we were just about out of time. We've been talking to Professor Lars Peter Hansen of the University of Chicago, who just won the 2013 Nobel Prize in Economics. In the last few seconds, can you just tell us how can people continue to follow your work?
The best way would be access to my webpage that has useful summaries and discussions of a variety of different types of research that I do. Overall, for the University of Chicago, the Becker-Friedman website is also a very good one.
Yeah, indeed it is. Okay, we are going to be putting a link to both of those on the show notes at goldsteinongelt.com. I'd like to once again congratulate you and thank you very much for joining us today on the Goldstein on Gelt Show.
Thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.